Thank you, Asima ji, for chairing the session. Since Dr. Surjit Bhalla ji is stuck in somewhere, he may join it or he may not join it. So the session is chaired by Mrs. Asima Goel. She was, as we know, that she was part of MPC till October 2024, and her role was very excellent in while sitting in MPC member. So we would like to hear her comments afterwards, my comments. So she is former member and Monetary Policy Committee, RBI, and Dr. Charan Singh, advisor, ASSOCHAM National Council for Banking and Chief Executive, EGROW Foundation. And other panelists are Sadaf Syed, Co-Chairman, ASSOCHAM National Council for NBFC and Infrastructure Financing, and CEO Muthiit Microfinance Limited, and Sri Sujit Kumar, Chief Economist, National Bank for Financing Infrastructure and Development, Ms. Upasana Bhardwaj, Chief Economist, Kotak Mahindra Bank, Sri Indranil Sen Gupta, Professor of Practice of Economics, Shiv Nadar University, Sri Siddharth Sanyal, Chief Economist and Head of Research, Bandhan Bank, Sri Arun G. Nagarajan, Chief Economist and Communication Manager, Sundaram Asset Management Company Limited, and Sri Basudev Mukherjee, Assistant Secretary General, ASSOCHAM. So I would like to thank ASSOCHAM and EGROW Foundation for organizing this Shadow Monetary Policy Committee meeting discussion on RBI monetary policy. And so, as we know that from 4th December to 6th December, RBI MPC meeting is going to held, and decision will be decided on 6th December. And as of now, the repo rate is 6.5%. So industry wants that interest rate should be reduced as early as possible, even in this December meeting, because our GDP for quarter second is just 5.4%, and in quarter first it was 6.7%, as against the targeted GDP for financial year 24-25 by RBI 7.2%, and inflation target was 4.5% for the full year, and inflation for October was 6.21%, and for September it was around 5.5%. So I think there is a challenge for the RBI considering the inflation to reduce repo rate by 25 BPS as industry is expecting. So there is more likely if they ignore the wishes of industry as well as two union minister, they can pause the interest rate, and they can consider in February meeting, monetary policy meeting in February. So because there are various factors why industry wanted it: slowing economic growth, elevated this inflationary pressures, global uncertain environment, and moreover the green shoot, which shows that we have seen that our GST, which has increased 1,84,000 crores, 8.5% increase Y-o-Y, and this FAD rate has been reduced 2 times, one 50 paisa, other 25 paisa. And this time the president has been, Mr. Trump has been president-elect. He will take over in 20 January 2025. So as things are expected, he will impose tariffs on China, Mexico, Canada, and even on India. But I think more tariffs is to be levied on any import from these two countries in comparison to other countries. This is expected. So inflation will be there in US also. And because of that inflation, it may be possible that future rate cuts by Fed should not be there. And when future rate cuts will not be there, and then their inflation will be increased, and bond yield will increase, and therefore money will flow to emerging market, to US, even from India to US, and it is already moving. So their currency will remain strong in comparison to India and other countries. Even dollar index has been strong. It is around 106. So considering all these, there is a greater challenge with the RBI, that uh, uh, to reducing interest rate, because tolerance limit is 6%, and in October it was 6.21% inflation. So I think it will be very, very interesting to understand um, from Asima Goyal, since she has been MPC member also, and she's earlier she used to be the speaker in this forum, and today we are very much interested to see her views, whether RBI is going to reduce it or not. So once again, thanks to all the speakers. It is a great meeting, and I think our views will be very relevant to the MPC committee members. Thank you all and welcome you all. Once again, over to Asima Goyalji for further comments. Thank you very much.
Thank you, Agarwalji. So I'm happy to be with all of you once again. And as Shri Agarwal was saying, RBI has a is facing a difficult situation where inflation has exceeded monthly inflation has exceeded their tolerance band, but GDP growth has come in much below their forecast of Q2 forecast of 7%, GDP growth is 5.4%. So both inflation has exceeded their forecast and GDP has come below it. But when we look more carefully at these, at the inflation and growth and the prospects, then the inflation is due to largely vegetable food items, vegetable, etc., which are seasonal with a short cropping cycle, and because of the good monsoon, expected to come down. So forecast of inflation remains by mid next year around 4%. That means that the real rate is very high, because monetary policy has to be forward-looking. You know, the expected, because there are lags in its effect, the expected real rate is what affects activity. And apart from the good monsoon, we also have that international palm oil prices are softening. Then it's expected that he will reduce the ongoing conflicts and oil prices may soften. Anyway, there is room already to pass on some cuts in oil prices, which can reduce inflation. But when we look at GDP, then we see a trend reduction in the interest-sensitive components of GDP, specifically manufacturing, construction. Yeah? So it seems, as I was saying, this lagged effect. Real rates have been high, above 1% for almost between 2 and 3% for the last so many months. And we saw this in the 2010s also. When real rates reach such figures, it triggers a slowdown in manufacturing and in investment. We are seeing that again. So we must learn from history. Then the other, the economy did very well for 3 years after the pandemic. And among the factors which helped was counter-cyclical smoothing of external shocks. So there is an export slowdown. And with the Trump presidency, there's more global uncertainty, volatility expected. So that means again that domestic policy must counter this to smooth these shocks, that domestic demand must be supported. And the other argument that there's some structural problems because of which consumption is low. It is not urban consumption, but somebody who's a fabulous TV actor, he's been the winner of Khatron Ke Khiladi, he's been a vote. Please mute yourself, everybody. The alternative story that there's a consumption slowdown, the current data doesn't support it because we see that consumption growth has risen from 4% in H1 to 6%, although it's slightly slower than in Q1. So I'm going to have a black today, guys. And if it was lower income growth that was causing this contraction, then you would expect service demand for services also to fall, but that remains high. So again, all this data supports that it's the interest-sensitive components of industry, of output that are slowing. And since there are many speakers and we have less time, I don't want to take a lot of time, but I'll just emphasize again that a few sort of principles that really worked that helped the economy reach this 8% growth over 3 years after the pandemic. One is the real rate of interest must not be greater than 1%. There must be counter-cyclical policy, smoothing of shocks. And that for credibility of inflation targeting, just raising rates if there's persistent inflation is sufficient. Rates do not have to be high. And the MOU that the RBI signed with the Ministry of Finance is for flexible inflation targeting, which gives the MPC 3 quarters before they have to write to the Finance Ministry if inflation is above their tolerance band. And this flexibility, these 3 quarters are built in specifically to deal with transient supply shocks, such as we are facing now, that are not expected to have persistent effects on trend inflation. So therefore, my call is for a rate cut in this policy itself. And now I will turn to the other participants with just a few guidelines. One, I believe in this forum, we are trying to give advice to policymakers, teach students, right? So our perspective must be that of what is best for the economy. Many financial market participants, analysts especially, have to give a call, have to try and predict what RBI does. That is what their clients want. So you are welcome to say what you think the RBI will do, but I also request you to say what you think is the best, given the current situation, what is the best for the economy. For example, all the banks want rates to remain high since they're worried they won't be able to pass them on to high rates to they won't be able to pass on rate cuts to depositors. Deposit growth is relatively slow, but ultimately banks will do well if the economy does well. So with that, I turn to Dr. Charan Singh for his comments.
Thank you.
And also I request all of you to take 5 minutes, not more than that, to be brief because we have less time. Yeah, please, Charan.
Thank you very much, Dr. Ashima. I would like to take over from where you left, and I totally agree with you that while the growth rate has slowed down to 5.4% in Q2, the interest-sensitive areas, especially the manufacturing, has shown a tremendous reduction there. From Q1, 7% to 2.2 this year in the Q2, and 14.3 in Q2 of the previous year, 2.2 this time. It's really a matter of disappointed and matter of concern. You're right. Same thing happened in construction also. In construction again, we are recording about 7.7.
Please, everybody mute your.
Yeah. So you are right in that sense. I was looking into the analysis further, and I was looking at you are right, consumption expenditure, private consumption expenditure is doing well. But if you look at the gross fixed capital formation, that is significantly down. It is down from 11.6 in Q2 of the previous year to 5.4 in the current year. That substantiates the fact that you were making on the interest sensitive sectors, and you know that gross fixed capital formation certainly is a function of the interest rates. If we look at the high frequency indicators given in the release with the GDP, we notice that the production of cement is down from Q2 of the previous year, 10.3 to 3 this year, and the consumption of steel is also down from 17.7 to 12.0 this year. Now, if we look at, and this is of course the Q2, but if we look at the data for October 24, which has been released, find a similar trend in terms of steel. You find, okay, there is, compared to the previous year, October, November, the steel production is down. And if we look at cement again is looking downwards. So yes, that shows construction is down, and that also shows that there is an impact on interest sensitive areas. The point which you make, and I totally agree with you, in a country like ours, where prices of tomato or prices of potato or prices of onion decide what inflation would be, and therefore one has to really look into the causes of why inflation is behaving the way it is behaving, and is it structural or is it just because of the vegetables that are playing there. I would like to make two more points and conclude. One is, we had raised our interest rates significantly, considering that the countries with which we trade or from where we get capital flows are also reducing or raising their interest rates very high, specifically the US. As you know, that USA has opted for a decline in their policy rate twice consecutively. You'll be also surprised to know that the European Central Bank also cut its interest rates in October, and the UK, the Bank of England, has also reduced its rate from 5 to 4.75 in November. So given this scenario where the Euro has done the first cut, America 2 cuts, Bank of England has done the cut, I think we will have to, in our country, also now opt for a rate cut. I think already the sacrifice ratio is very high for a country like ours. We have delayed the rate cut as it is, and I must mention that the 30-year average of inflation in the US is around 2. So is the case with Euro area and England. And you know that in the US, inflation is still around 2.6%, and in UK, it is around 2.3. In Euro area, it's also around 2.3. Despite that, they have inflation targets anchored around 2. We already never had such high inflation in the first place itself. But given that situation now, that when there is a rate cut happening in those countries which we were following step by step, I think it's time we also do go in for a rate cut, so that we are able to spur investment and we are then able to spur growth. So my recommendation to the RBI would be, please reduce the repo rate. Thank you.
Thank you, Charan Singh. Very crisp comments. And I totally agree with you that there is more space for our rate cuts as other countries are cutting. But, to link it with Shri Agarwal's point that we will see debt money flowing out to the US as they don't cut rates as much because of Trump. I mean, one of the things we found in the MPC is that because of our sequenced capital account convertibility, that UIP, or the interest sensitivity of debt flows, is not that high. They're also very less than 4% of our domestic market. So we have considerable freedom in our rate cycles, in setting it. And the rate spread had fallen to the narrowest in 23. 22, as the Fed continued cutting and we stopped, but still we did not see debt outflows. So we don't need to worry so much about, and I think they're more attracted by our growth prospects. India still having the highest sort of rates of growth and prospects in the world as one of the largest countries with good growth prospects. Now I turn to Shri Sadaf Saeed, who is co-chairman of ASSOCHAM and NBFC and infrastructure financing and Muthoot microfinance. So all the areas you deal with, what is the perspective on how a rate cut, how the monetary policy stance, what stance will help, what kind of position on rate cuts? Yeah, please.
Good afternoon, everyone. Thank you very much, Ashmaji, for inviting me. I think most importantly, I represent microfinance business, and we deal with really at the bottom of the pyramid households. And this has been in conversation for a long time lately, for maybe not the right reasons, but yeah, I think the impact of inflation is really being felt. I should mention this. I think inflation, we all know, affect differently the poor households because at an urban level, inflation usually people cut their luxuries first and then move on to the necessities. But in rural household or the poor households, what happens is that the people cut their necessities in a sense that what goes out first? The first thing that goes out is installment, which is due, and the rural borrower deprioritize unsecured loans. And I think RBI has done a right thing to curtail the growth of unsecured loans, taken steps to ensure that. I think that is in the interest of the industry to prevent any further damage. The thing that we are witnessing is inflation and persistently higher food inflation. The inflation new print is 10.87%, and it has been in the range of 8 to 10% for some time now. And food inflation is kind of an inflation which hurts every single household. It's not one household or the other. And especially in the rural household, because the other aspect is that the rural wages have also been stagnant. If you look at the real growth in the rural wages have always been negative. If you nominal growth has been for last 5 years is 5.2%, but real growth is almost negative. So I think both the things put together puts the rural economy in slightly kind of a difficult position. What is also important, and I very categorically vote for a rate cut here. And why I vote for it is there are two aspects of it. One, of course, the interest rate cuts reduces the burden, but the transition of the rates is not very immediate. It takes time. It is not also 100% all the time. So that is one aspect. But more important aspect is the rate cut will increase the cash flow in the economy. And at the bottom of the pyramid, right now, the challenges of cash flow, because all of a sudden reducing business or stopping business really impacts the cash flow. Essentially, the business that we are in, though the nature of business is a term loan, the funding that we do, but essentially the rural borrower uses at a working capital flow. And if the working capital stops, then the business stops, the production stops, and of course, the affordability of the repayment and other necessary stuff is stopped. So I think the reduction of rates will have a very positive impact if there is a 25 bips reduction, and it will improve the cash flow. And I think RBI has done a good thing in terms of stopping excessive flow to the unsecured loan, but the right amount of flow will definitely help the economy smoothen out, and especially the rural household would be better off. That's my submission.
Thank you. Yes, excellent points. I think we are seeing a lot of data that there are multiple loans being given to the poor. They're borrowing from one party to repay the other. And so lower, and so we are seeing NPAs rising as this is being stopped. But I think lower interest rates will really reduce the burden. And as you're saying, improved cash flow. There is a suggestion for the RBI to cut CRR. And in general, I've always supported adequate liquidity in the system so that the rural economy, the small borrower, is really cash dependent. So thank you for those points. And now we have a view from NABFID and infrastructure finance. We're looking forward to hearing what is the perspective from there. Because I think we are seeing household construction also come down, which was really maintaining inflation. I don't know if household construction loans are affected because of interest rates. Yeah, please go on.
Thank you, ma'am. Thanks to all esteemed panelists for already setting the context. 3 points I wish to add. One is that government sector all said and done remains a very important constituent of India's demand. And of late, what we have seen in past 5 years that government spending has tilted towards capex. Now, if we take the first half data, both center and states combined, the capex is down actually. So that way, the fiscal impulse is negative, even overall basis. Secondly, since we had a very high real rates for almost 6 quarters now, inflation actually averaged on a quarterly basis below 5 or around 5. So 1 or 2 readings above 6 should not worry us, right? I think Asina ma'am rightly said that the mandate said that you have to be below 6 for 3 consecutive quarters before you have to explain to government. So 1 or 2 readings should not make MPC lose heart in its mandate from that perspective. And coming to inflation part, I think it's mostly transitory because the drivers of inflation is very seasonal. With harvest coming in, it's anyway going down. And also there was a base effect which was at play in October and September, which may reverse. So from that perspective, even RBI's internal forecasts are that in Q4, you will have numbers much comfortable on inflation point of view. So given the context that we are in, growth has been much weaker than what even I would say pessimists had also factored in. And since monetary policy operates with a long lag, it's a good time actually to make monetary policy also support demand rather than be a drag on demand. One additional point that I wish to make in this context is that since we think of that reducing interest differential might cause flows to move out of India, I think Seema ma'am has already given the research perspective on this. I think higher growth is a better insurance for having flows coming to India than any interest differential we are thinking of. So even from that perspective, the case for having lower interest rates is very material, and I would actually vote for Reserve Bank to consider easing rates rather than waiting for inflation to perfectly align with the mandate in long term. So that's where we are.
Thank you. Excellent points. It's true. I think the RBI has been talking about aligning with the target, but that was dependent on growth, being high. They felt that growth was robust. Now we are seeing that growth is not robust. So there is scope for relooking at that. And also your point about fiscal spending, I think in India we progressed a lot if during the election period the government actually spends less. Because earlier economists used to see a lot of money going into the system during election periods. But this time we have seen that government spending has really reduced. And that should turn around and help boost capex. But we need to see private investment also rise. So, yeah, thank you. Upasana now. We're looking forward to hearing about the bank view. I know banks don't want rate cuts. And you should make the case why rate cuts are harmful for them and for the economy. But also, please separately say what, from the bank perspective, from the guidance to your clients, and what you personally as an economist think is best for the economy. Yeah.
Yeah, I think 2-3 points here. One is, of course, to begin with, GDP has shocked everyone. The kind of fall I don't think anybody was expecting. And that does provide a sharp downside risk rather to RBI's own estimates of 7.2%. And at the same time, RBI has been very optimistic throughout, even when the whole of market was on the softer side. When we look at the H2 estimates of RBI, they are at 7.4% average. The recent RBI bulletin also, when they revised down their Q2 numbers to 6.7% estimates, they actually were expecting Q3 numbers to bounce back to 7.6%. So I'm just trying to highlight there is a lot of inherent optimism still there within RBI, number one. So now in that background, of course, this second quarter GDP that has come about, which we'll have to see how they really take this forward and accept it. In the sense, do they really revise sharply down their full year numbers, or they still, keep the second half more optimistic than where most of us are? We are looking at a revival clearly from, so, if you look at the high frequency data up to August was the trough in activity. September, October, we have gradually seen a slight pickup. Of course, it was linked to festival season. We have seen a slight revival in September and October. We will have to see whether November data, of course, we don't have much except for PMI, but otherwise we'll have to see whether how the data pans out. But at this point, the second half of GDP also looks extremely lower than what RBI estimates. We are looking at about 6.2% average compared to a 6% average in H1. This clearly provides room for RBI action, and earlier than what any of us were anticipating earlier. So this is one thing. Having said that, I just want to put one thing in perspective. I will also exclude the elevated inflation scenario because, if you look at inflation ex vegetables, then it has been at sub 4% throughout. So fair enough, 2 months of reading, we can ignore, which is going to be elevated. But I think what is more important, which RBI should be cognizant about, is the tightening liquidity conditions. Now, at this point, Q2 was very comfortable on liquidity. Core liquidity in the beginning of October, which is the durable liquidity, was about 4.5 lakh crore. Today, we are at about 1.2 lakh crore. So this drop in core liquidity is clearly something which will provide a fair amount of stress in the system going ahead. And going ahead, if repo rate cut happens in December, in this tight liquidity, it's a wasted cut. In this tight liquidity situation, then it's a wasted cut. So my recommendation is go ahead with CRR cut at this point and probably act in February with a repo rate cut, because we need to have the benign conditions to ensure that the transmission also starts. Otherwise, I would say that this will be a wasted 25 basis in an environment wherein globally we may say FPI outflows may not happen incrementally, but it is a environment in which INR is weakening and RBI would want to balance out all the risks. So my recommendation is at the moment, pause on repo rate and do a CRR cut. 50 basis is a CRR cut we are looking for. Of course, it may not happen immediately. It may be 25 basis now and another, fortnight, we have another 25 basis. But yeah, cumulatively, also because 4.5% CRR is a very high penalty rate for the banks. Pre-pandemic, we were at 4%. So it is better to revert back when we are talking about pre-pandemic policy normalcy in all ways. Then I think CRR also deserves to be back at 4%. That is important. And from a client point of view, or from a, what we see is, of course, the credit side is still holding up, and this credit deposit ratios do remain a stress. So in an environment when liquidity is tight, repo rate cut happens, clearly it is going to be increasing the stress on the banks. So we need a little comfortable liquidity before we can really think of better transmission through the banks. And hence, I would say a pause on rates and CRR cut is a better recommendation.
Okay, finished?
Yes, yes.
Thank you, Upasana. Very good points that you make. But this liquidity issue has always puzzled me, because under inflation targeting and the repo and the LAF corridor, liquidity is supposed to become endogenous, right? But banks are not comfortable with overnight liquidity. They want durable liquidity to be a certain amount. And they're not willing to lend to each other. More of that should happen. There are some banks that have surplus liquidity and others that. So why isn't the money market developing in that direction? I agree with you that, because of dollar sales, etc., liquidity they need to sterilize those dollar sales. And I think over the last few months, you see the RBI has been moving towards easing. That is, liquidity has become comfortable. Before that, for 6 months, it was very tight.
Yes.
That helped increase the spread of interest rates and made tightening even more than just the repo rate, right? That they have reversed. So I'm sure they will provide liquidity, do whatever is necessary. But my question is, why don't banks more actively share liquidity, and why aren't they comfortable with overnight liquidity, which is just endogenously? Or, they have longer tenure borrowing.
Yes, I think it's about the tenor. The curve is yet not defined nicely in the market, and we are some way away from that before we can really expect. Like, for example, when RBI provides 14-day liquidity, or absorbs, rather, I should say, from the system, then the uncertainty with regard to the flow of funds within the banking system now, especially probably because we are in this digitalization phase where, there's huge amount of mobility of funds, that kind of prevents the banks from taking a little extra call, and there is a need to be much more agile on that front. Maybe that's one of the reasons why we're not seeing this develop much more deeply. But having said that, we have seen phases when banks are lending to each other. The previous quarter was relatively more benign. The overnight rates were hovering much more closer to the lower end of the LAF corridor compared to even the mid part, as in at repo. So we have seen phases like that, but now all of a sudden we are again on the other side. And then when we say aligning to liquidity and policy stance have to move in sync, basically. And that's where, and especially when RBI's intervention is the key driver of this structural liquidity tightness. So somewhere the reserve money growth is not going to be in sync with the requirement of, even if the nominal GDP growth is 8%, then we need that to be in sync. And hence the need for liquidity infusion by RBI is, I think, necessary at this point of time.
I think they are in the phase where they want to ensure liquidity is comfortable. So it should happen. It should happen. But the system should ideally adjust smoothly to shocks, such as even large outflows, without it leading to liquidity tightening. So that is
what happens is then we need to also see rupee adjust accordingly. I think it's about all parameters when we see if market forces prevail, rupee is allowed to depreciate with market, then the need that it is an automatic adjustment that we see across all parameters. And I think that's where it happens when an external agent, that is RBI here, from outside the system is acting, then it's difficult for the system to adjust, because nearly between October to November, our estimates suggest about onshore spot intervention worth $35 billion. That's huge. That's close to a 3 lakh crore worth of liquidity withdrawal in 2 months' time.
No, but I wonder, I have this theory that, the rupee volatility has been lower. RBI always says that it's market determined. We are only preventing excess volatility. And there is research, and exporters, moreover, say that the highly volatile rupee doesn't help them. Yeah?
Yes, RBI's own studies.
They don't get the price passed through, etc. And it raises risk premium and the cost of borrowing and spreads, emerging market with fear of depreciation and so on. But now, currently, the offshore market is brought onshore through GIFT City, because banks can take positions there. So isn't it that even during crisis times, the domestic position on the rupee affects the onshore? I mean, the onshore affects the offshore, so that the rupee volatility is somewhat less because of that, rather than RBI intervention only.
Since October, the RBI intervention is more than, 35 billion is only onshore. Another 35 to $50 billion is offshore intervention. Cumulatively, the intervention probably is anywhere in the range of 60 to $80 billion. So the volatility that we talk about is low because clearly there is RBI there. I think a bulk of it, I'm saying $70-80 billion is a lot of money. So I think October onwards, if you see, it is a one-way move, of course.
Yeah,
that much of intervention.
There should be more market volatility to let the market do price discovery. But at the same time, you can't let the rupee if outflows are going out, what are the amount of outflows that went out, in this period? You can't let the rupee take that whole brunt, because that would create a lot of problems for the real sector. Anyway, I think now we should ask Indranil for his comments. He has newly become an independent economist. So you can maybe give us how being a bank economist affects your outlook and how it has changed since you become independent.
Yeah, thank you. So now that I am in academia,
Yes.
you see, I have been calling for a rate cut for more than 6 months, and essentially on the point that your real rates have crossed 1%,
Right.
and past shows that whenever that happens, growth slows. And were you to look at GVA instead of GDP, that slowdown was fairly obvious.
Right.
Now, I do appreciate that the RBI had concerns about the rupee, but now the Fed has started cutting, and what is happening to the rupee right now is more of a dollar move, which traditionally the RBI has not tried to sell. But that said, so if you ask me what should the RBI do, I would say that they should cut, certainly. That said, I doubt very much they will maybe create a position for February, because if you see, the governor has been extremely hawkish on inflation. He said that even food inflation I am going to look at. The RBI, incredulously, in my view, came out with a paper which said that the real interest rate has suddenly climbed to 2% as optimal. So all these things make it very, very difficult to do a U-turn at this point in time. So I would think that maybe either a CRR cut or a OMO now, and a cut in February is probably what they could do. But then that wastes an opportunity, because if you cut in February, the busy season is done.
Yeah.
So what do you achieve? Really nothing. But given the strident note that the RBI suddenly struck, I mean, we have been seeing RBI keep very low rates when inflation was 7% and so on. I do understand that there are uncertainties about the US. Core inflation annualized is somewhere around 3.5%, 0.3% month on month. So it's not very clear how the Fed can continue to cut a lot. But in India, and this is something I have always held, that RBI rate cuts actually support the rupee, because FII debt investments are barely 5-10% of equity investment. And debt, equity investors typically chase growth. So if you cut rates, you get more equity flows. And even debt investors, if they see that there are capital flows on the equity side, which will hold the rupee, and they see interest rates going down, so they sense there will be capital gains and they come in. Right now, what have we achieved by holding rates high? Debt investors are leaving anyway, because all the expectations of their capital gains are, they don't see those materializing. So net, I think, obviously, given that I've been calling for rate cuts for so long, I do think and do believe the RBI should cut. But given the situation that they have created right now, I think it's very difficult to cut this month.
Yeah, I think that's true. But, the governor has always been, as you're saying, emphasized the target. But he's always said that high growth gives us the room to do this. Now that growth has come in much lower, I think if he wants to, he can use that as a argument for doing a cut now.
No,
Because,
I strongly believe he should. But
no, because like I was trying to say that we are seeing a trend reduction in interest sensitive. A lot of media and analysts are saying that there will be a reversal. That's what the RBI was also saying, that government investment will pick up, etc., etc. But I think this kind of trend slowdown is not so easy to reverse. It won't reverse just because the festive season. That won't affect the trend. Yeah. So you need to change something else in the system also.
So very quickly,
While the
consumption
while the
Right.
inflation is very clearly due to transitory, items that are likely to reverse. So, but
fully
the
agree.
slowdown is not transitory.
Yes, the consumption part has been slowing for a while.
Mhm.
And it's only, like one of my colleagues in the market used to joke that people don't have money to buy toothpaste, but they have the money to buy gold. I mean,
Mhm.
HUL is not doing well, but Titan is, in terms of stocks. So there's been a, pain point there for a while. And that's got camouflaged by the fact that, you had a high GDP because of net taxes. The GVA was slowing. And I'm not very sure what the consumption number in the GDP accounts mean. I think it's more a residual. But people usually in the markets look at the performance of consumer companies to see what is happening.
No, I
So
agree
I think
with Sad that inflation has really dented purchasing power for the poorer sections. But their rate cuts are not going to help, and rate cuts will actually increase their purchasing power because their, the interest servicing will go down, and also a better agricultural output this year should help them. So on. So just raising rates are not going to help them get over inflation-induced cut in there, or high rates are actually negative for that also. Yeah, so very interesting. Thank you. Now we go to Siddharth, who is also a bank, but this time a bank that focuses on lending to the poorer classes, right? MFI, does Bandhan Bank have a lot of MFI? What is your perspective? We're very keen to hear.
That's correct. We have a lot of exposure in MFIs, in affordable housing and MSMEs. So yeah, I put it this way, ma'am. We in this particular forum for last few occasions, we have discussed extensively about the need for infusing more liquidity from the RBI side. I hear your views when you, I mean, in the context of what Upasana mentioned. But I think if we see, and of course, there is in the inflation targeting regime, there can be a debate whether to what extent we assume money to be completely endogenous. But if I try to see in a long-term perspective, the typical reserve money growth, which is the primary source of liquidity from RBI to the market, or the banking system, has always been in the vicinity of 12 to 15% at the least, more often than not. Now, compared to that last 2-year plus period, this reserve money growth has been in the vicinity of 7%. So just about half the rate at which it typically grows. So far in the recent months, it has been the expansion in reserve money was through the accretion of net foreign assets. There was very little accretion of domestic assets. Going ahead, there will be huge question marks whether you can actually increase reserve money from the foreign assets part. Most probably it will move in the other direction. Here, RBI possibly it's an urgency that RBI needs a call on the reserve money, more particularly on the domestic asset front. How exactly they want to take their policies forward. I think there is a clear need to a great extent agree with what Upasana mentioned, that at this particular point, unless we have that the support for durable liquidity in the market, we might see the money market rates are not that volatile, but banks do not have the confidence to take it forward to the credit market. So basically, we will not be, so the why we are talking about rates coming lower. Rates will, a cut in rates will be effective only when, if there is, as we call, flow of credit to the productive sectors of the economy, whether we get to see that uptick in credit. Now we are in a situation where credit to industry for a protracted period of time is in single digit. For whatever little period of time it was moving close to double digit, now it in the last few months it has again started falling lower. I think there is a very urgent need to keep stepping on the infusion of liquidity on the part of RBI, so that the durable liquidity in the hands of banks become a lot more. and they focus really on the productive side of the economy in terms of credit expansion. Very clearly, there has been a clear focus on the part of regulator to reduce banks' exposure or financial exposure on unsecured loans. I think that's a prudent move, especially unsecured loans, it's not related to any kind of income generating or prospect of future employment or income. I think it's quite prudent on their part, and they very clearly they remain on that particular moving in that particular direction. But if we need to see the benefits of rate cut percolate down in the real economy, it's very important to ease on the liquidity side. I hope that is happening going ahead. Given the kind of the other part is that what do we expect on the rates front? I do not expect any rate cut in this particular policy. While the real interest rate is really high, and with the latest GDP number, very clearly the latest GDP number has brought us quickly much closer to the start of rate cut compared to what we had been thinking till last Thursday. I'll not expect the RBI to do that kind of a quick reversal in their public posturing, given what they had been saying for so long. Even though they have to be forward looking, given when there has been 50 billion dent in their forex reserve, including revaluation, of course, in the last 2 months, and the headline inflation rate. Now it's a different debate altogether whether headline is better or the ministry's view is better. That's a different debate. But when headline inflation has been inching higher and ruling at a level higher than their comfort zone at this moment. So my sense is that at this moment, okay, one last good point I wanted to highlight. One good thing they have very clearly done from October policy onwards, the stance sounded not only the formal change in stance to neutral, which was possibly long overdue. Very clearly, there is a tone down in terms of starness of policy communication. It's more nimble. The governor emphasized that a number of times. That will come handy in this particular policy. They will possibly extend that particular logic further, bring in a bit of element of growth expectations going ahead. And February remains a very clearly a live meeting. But rate cut, this meeting, I'll be very surprised.
Right, correct. Yeah, thank you. So as you're saying, this change in stance and the emphasis on nimbleness gives some room, right, if they want to use it. But another question: the Bandhan Bank has access to the LAF, right, to the RBI borrowing window, isn't it?
That's
because
correct.
Another issue, one reason why I always emphasize comfortable liquidity in my comments in the MPC, also I used to always say this, is because in India only commercial banks have access to the RBI, and for the rest of the system, it has to go through banks. And bank lending, for example, to NBFCs has fallen drastically, and that really reduces capital flows, flow of money to the lower sections. But your point on unsecured loans and the prudential weights. So because the idea is that I hope banks who are lending to MFIs, it's very profitable. They lend at very high interest rates. But that means that you have covered the risk of loss. Yeah, that is why your rates are so high, right? So then NPS should not be such an issue for you because you've already covered that risk. And second, if you're using fintechs and it's based on expected cash flows, even if it's unsecured, it's based on expected salaries, you're giving loans to salary earners, etc. Is that protected?
Well, there are two ways of looking at it, ma'am. If I see it just from a micro point of view of an enterprise, you may actually keep interest rates very high, build in a lot of credit cost, and still remain very profitable at the end of the year. But and we have seen certain segments of market doing it for a while, but we had been flagging it for a while that actually creates a lot of problem for the industry as a whole, because then you actually end up impacting the long-term credit culture of the industry in a very difficult fashion. You actually tap a lot of unsuspecting borrowers from not tier 3, tier 4, maybe tier 6 to tier 12 towns,
Mm-hmm.
and expand your books, etc., very, very rapidly there. And a lot of new to bank kind of customers, new to credit kind of customers. And then eventually you actually run into a situation which is not particularly healthy for the long-term sustained, strong, focused growth of the industry. So that way, a prudent growth path, sustainable, prudent growth path is possibly a lot more preferred than just thinking about the micro aspects of that particular enterprise had been our stance all along. I think we are aligning towards that. I don't see too much of a
because
risk on that.
risk-based actually means, you should also look into the effect of very high rates on the repayment possibilities, the NPA creation, apart from just covering it. So all this is prudent lending, and then the practice of lending 5 different people. Now there are credit databases available. No? So this
That's precisely what I wanted to highlight, that in the last 3, 4, 5 years, I personally have witnessed dramatic improvement in data analytics skills, and more than skills, focus of the industry in data analytics, which is possibly a great step that we are witnessing at this moment. That should help.
Good to see progress. Thank you very much. Now Arjun Nagarajan, he's with Sundaram, so we look forward to the market view from you.
Yeah, thanks a lot, ma'am. Thanks a lot for having me. I'll start off with 3 quick points and then view on the RBI. Firstly, I think this entire context, markets would love a rate cut. I don't think there's any doubt about that. But from a point of view of where we are, what has really changed from the last policy to this policy? It has been the GDP print. Now, GDP has been normalizing. We can't be looking at GDP prints every quarter at 7% plus. The question now is that the probable markets thought that it would normalize to around 6.5%, but it has normalized to a much lower number. The source, 2 line items appear to really stand out. One is the capex number, and the other one is the manufacturing number. And whenever you see capex pick up, you've seen manufacturing also move in tandem. So I would want to put the focus on capex in particular. Manufacturing, if I look at it from a volume numbers point of view, IIP number point of view, IIP has been seeing some sort of a moderation from around the 4% handle to a 3% handle in the September quarter. But the drop in manufacturing that has come in from nearly around a 7-ish to a 2-ish handle is largely on account of the fact that your earnings for September quarter, especially in the manufacturing space, has been much weaker. So that has sort of exaggerated the drop in manufacturing. So that was one point. The second is, as of now, as a H1 of FY25, your state capex has been, I think, minus 5% YTD year on year, and your center capex has been minus 15% YTD year on year. The October numbers have still also not really seen much of a pickup. If there is a pickup in capex, the momentum, the run rate appears to be much stronger. It has to catch up to FY22 levels. If that does happen, then I think December can see a positive pickup on the growth front. On the manufacturing side, the December quarter should see some positivity around the earnings narrative as well. If that does happen, you will probably see a marginal bump up in GDP numbers. So I think this is one context. On the liquidity front as well, though probably the RBI has been doing forex intervention, which is probably bringing down liquidity, the government hasn't really started spending. So everything seems to be boiling down to just the government spending to a large extent, and capex also to an extent. If that starts picking up to an extent, I think liquidity also should get marginally better. Though I think that the RBI might not do a CRR cut, given that it's a much stronger permanent liquidity infusion of sorts. I'll come to the last bit on rates. Always the question is what the RBI should do versus what the RBI will do. So if I take the RBI, what the RBI will do first, I think they will do a pause. They will not really tinker anything at all on policy rates, largely on 2 counts. One, the RBI has been uber positive on growth for a while now, and like I think Mr. Sen Gupta also mentioned, on the inflation front, they've been uber hawkish. I think they even made references talking about how horses bolting out of stables, they really need to keep inflation in check. So that inflation narrative has been extremely hawkish. So from a positioning point of view, from the point of view of policy continuity, I think the RBI would probably deliver a pause in the December policy, maybe bring in some more realism in their growth projections and do more of a verbal intervention of sorts. I think that's what the RBI probably will do. Now, what the RBI should do, I don't think the RBI should be cutting rates at this point in time. I think it must be verbal intervention, a much softer version of what they saw in September, for two reasons. One, if they do deliver a rate cut, I think from a market's point of view, where markets are, they might read that as a negative signal that the RBI is really worried about growth. I don't think the RBI will want to, rather should give that sort of a signal. Second, 20th of January, we all know, I think Donald Trump is taking over as the president of the United States. And after that, I think that will decide the course of 2025, what narratives come in there. So there's a fair bit of uncertainty. More importantly, a Chinese response will be directly dependent on how strong or how acerbic Trump's reaction is on tariffs and on commentary. So given that there's so much of uncertainty, especially on the commodity front as well, given if China's response is extremely strong, then it can trigger a commodity cycle as well. So the last thing the RBI will want to be caught is off guard, especially on the direction of the policy front. So therefore, given that there are so many uncertainties, I think the RBI should probably pause, but there should be much more verbal intervention, giving some sort of a soothing narrative to market, saying that we understand probably we'll have to bring down our growth projections a bit more, but let's just wait and see. Let's take a call post the budget. I think that's probably what the RBI should be doing at this point in time. I think I'll stop there.
Thank you, Arjun. Very interesting. Now, this point about global uncertainty and therefore pausing or remaining slightly hawkish, I think that's the opposite of what has worked in the past 3 years, as I was saying in the introduction, because it is smoothing shocks. If you expect shocks from abroad, you should boost domestic demand to compensate. We are a large economy, we're a diverse economy. That is our strength, and we should use it. Yeah, that's a slightly different perspective. And the other thing on RBI being uber hawkish on inflation, I was there in the MPC in the middle of the year, and in the June policy after the elections, I felt they should cut. I wanted them to cut even before, but that was internal, because let the elections get over, all the election-related uncertainty. But that time they were very worried because household inflation expectations had ticked up. So they thought there might be persistent rise in inflation. But the change in stance came because in the next policy, household inflation expectations actually fell. So it was more related to the heat wave and its monsoon kind of related issues that affected household expectations. And then they felt that inflation rise is not going to be persistent. So you see, that is when they brought down their forecasts of inflation for the next year. So the guidance to the markets comes from those forecasts also. They have brought down their forecasts of inflation. And if inflation forecast is around 4.1% in the summer, that means there's a lot of room to cut. Yeah. Then the third point I want to make, because markets seem to, again and again, the MPC has said that we are data-based. We have told you our reaction function, that we put more weight on inflation if growth is doing well. If you remember, just after the pandemic, everybody was saying, you're not tightening, it's too much liquidity, inflation is rising. Then the narrative was that we want growth to recover. So we are, So here, again, as I said, that growth has really slowed, gives another, and then when you say, so the speech or the governors, the perceived hawkishness on inflation is in relation to this, that wanting to reach the target because growth is high. Yeah. So don't take that as guidance independent of data. That is what I'm saying. Data-based guidance means that you are free to change when data changes. You are not bound by what you said, because what you said was related to the data. And the guidance is that that we are data-based, and markets should look into the data and then see what we're going to do, not what we said when the data set was different. Yeah, that's all.
Fair enough. But would you mind if I ask you? No,
Yeah.
Fair enough. But just one small point here. Post the inflation targeting framework that they've sort of adopted, personally, I felt that what the RBI says, RBI is sort of straitjacketed to always give a narrative around inflation. And probably from an economy point of view, maybe we're not mature enough to sort of accept inflation targeting as a framework because we're still largely a cash economy. So reading between the lines probably is more appropriate at this point in time, given that they can't keep switching their narratives. Would that be a fair understanding?
Yeah, I think that you need to look at the data much more and what is said in the context of current data. And because we as you know, we do get a lot of shocks. This is global, and especially for emerging markets, we get a lot of shocks in liquidity and outflows in food and commodity prices. Yeah, so there is a freedom to act. And we're not bound by the narrative given in the past. It's not guidance. It's not forward guidance in that sense. It's data-based guidance. Yeah, so I think we stopped there. We have only exceeded time by 10 minutes, and we're doing quite well given the large now. I think a very interesting discussion. So now I think everybody wants would like a cut, except for the 3 financial economists, 1 market and 2 banks. So that is again expected. But if Charan, shall I give it to you? Are there any questions from the audience, or do we end now? Yeah.
Professor Goel, I have one question.
Yeah.
Your recommendation is a cut, but what do you think will happen?
Well, as I said, we don't give forward guidance. And I've been highlighting some loopholes that are available to the governor and telling you that don't tie him to what he said in the past.
Fair.
He says he can be nimble, right? So he has the freedom to act in whichever direction he wants. Yeah.
Fair.
Upasana is settling score with you, Ashima.
Yeah.
Not at all.
I think, no, not at all. Of course, I know that. But, you know,
No, I think we both enjoyed the interaction, right?
Yes,
absolutely. No settling of scores.
All right. I think normally the trend is we don't take question answers, but you are in the chair. Whatever you decide, we will follow suit.
No, I think we should follow the time given. So since the time is up, I think we can end there. Yeah.
Yeah,
Unless anybody in the panel has a question or issue they want to raise. Okay, so let's see what happens in this week. Yeah. Thank you. Very interesting.
We will go back to ASSOCHAM. I think they have the thanks note of thanks that they provide. Rajesh, Dr. Rajesh, we are back to you.
Thank you, sir. Thank you so much. Basu sir, over to you, sir.
So, so this has been an interesting session. Indeed, there's been a lot of interesting points being made, and you know, given the latest GDP figures, the discussion has really become very lively. So what we are going to do is that we are going to take all these inputs and compile them, and we will be taking these up with the RBI, submitting our recommendations on behalf of ASSOCHAM. And you know, just like to take this opportunity to thank Dr. Goel, Dr. Singh for being with us, all our eminent panelists, and we will see you once again in another 2 months. So thank you once again.
Thank you. Yeah.
Thank you so much.
Bye.